real estate just presents so many opportunities for individuals when it comes to the tax advantages that they can provide, that regular cash flow, the lack of correlation with the public markets.
Welcome, everyone, to today's Hero Capital Raising Show. I'm your host, Tim Mai. And today I have a special guest on the line with us, Mr. Michael Haigh. He's with ATX Acquisitions. Mike is the Director of Investor Relations and Portfolio Management. He has a big background with finance, operations, investing. And the ATX, they've done over $2 billion worth of multifamily real estate. They currently have over $600 million asset under management. So super excited to hear more from Michael to share with us the operations. And and with that, let's give Michael a big welcome, y'all. Woohoo! All right. Welcome, Mike. Really, thank you so much for being on the show with us today.
Yeah, I appreciate it, Tim. Looking forward to talking to you guys.
Yes. So yes, if you can share with us a little bit about you and also too about ATX and ATX's history.
Yeah, absolutely. So I'll start with my brief personal introduction. I've always been really interested in the investing space. I was in college during the GFC. So that was a time when I really dug in and tried to understand, why did this happen? Why did so many people miss the impending situation in the economy? And more importantly, how could I have a career where I could help people navigate that in the future, help worthy institutions navigate that in the future? And so that was something that was always in the back of my mind. And coming out of college, I graduated with a degree in economics, but I started working for the University of Chicago's endowment. And the goal there really was to have a broad understanding of pretty much every part of the investment space. The University of Chicago's endowment has $14 billion in AUM, and they invest across every asset class. So that gave a really good broad exposure to pretty much every asset class you can think of. We had private equity allocation, say about 20% of the portfolio, including venture capital within that. We had a real estate portfolio as well. On the real estate side, we were primarily LPs. And if you take basically the top quartile funds, large institutional funds out there, we were primary LPs in almost every single one of those. For the most part, they would look for investors like us who were ones that were aligned, who had long, stable portfolio that could be with them in subsequent funds. And then, of course, they liked the mission base of being tied to a university. We also invested in the public markets, a lot of hedge funds as well. So overall, that was just a great exposure to what are the different investing strategies out there. How do you build a well-diversified portfolio? How do you take into consideration downside risk and make sure that you're not putting your portfolio at risk? And it's a model I think that every individual investor can duplicate as well. That's basically known as the Yale endowment model, but it's a very similar investing philosophy that a lot of individual investors can take in their portfolio. But coming out of the endowment, I got my MBA at the University of Chicago. I worked in private equity for a couple of years, but I was really drawn to real estate because real estate just presents so many opportunities for individuals when it comes to the tax advantages that they can provide, that regular cash flow, the lack of correlation with the public markets, so that downside risk as downside mitigation for them in their portfolio as well. And so that's really why I decided to join the ATX team. The ATX team has a long established history. Our founder started investing in real estate in 2005. So he invested all the way through the GFC, managed to not lose any investor capital. And coming out of the GFC, he was looking, where's the biggest opportunity in real estate? He identified multifamily real estate, primarily large multifamily real estate. They targeted Texas and Florida. Now it seems like that's a very obvious play, but at the time that was a bit contrarian, where a lot of people were still investing in the big coastal cities and in the more traditional markets. But we always take a deeper analysis, looking at where are people moving, where are the jobs moving, where are there incentives in place for businesses to move there, where are there tax advantages for businesses, where is the quality of life and cost of living lower relative to the overall US population, where's the GDP growth outpacing the US population. So as a result, Texas and Florida have been heavily our markets for the past 14 years. and we've been very successful in those markets. We've averaged above a 20% net IRR. And this is all in value add. So class B, class C, multifamily. We've more than doubled our investors' capital, normally over a 4-year hold period. And they've done very well in their cash on cash distributions as well. To give you just a brief history on the firm there, from 2010 to 2018, we did 99 acquisitions. At peak, we had $2 billion in AUM, 17,000 units. In 2019, we were taking a look at the market and saw that valuations had started to get a bit frothy. Cap rates were very low at the time. Interest rates, of course, were close to historical lows. So we made the tough decision, rather than to continue to build up our asset base, continue to accrue more fees, we made the tough decision to sell the bulk of our portfolio. So over the last 5 years, we've sold about $1 billion in assets, and we've been very patient. We've made 5 acquisitions over the last 5 years, but have been waiting for a buying opportunity like we're seeing today. We're very excited about the upcoming distress and just overall decrease in valuations, particularly in multifamily. We do look across other asset classes, and we will continue to invest in other asset classes. But right now, we're very focused in making acquisitions in large multifamily over the course of the next 24 months. So I'll pause there and see if you have any questions.
That's awesome. That was an awesome introduction, background about you and about ATX. Before we get into ATX, I have some curiosity questions around your experience with the endowments there, with the University of Chicago. I just love to learn more about how that whole endowment world works. Do they only invest in institutional grades type investments, or what are some of the buy box for them?
For the most part, they do, because they are somewhat limited in the sense that they have minimum check sizes that they have to deploy. So typically in real estate, their check sizes at the time were 25 million. That limits the funds that you can go into, but also because they had access to the top funds out there, they didn't necessarily have to take the risk on an emerging manager where they would look for allocation and just the top funds out there. They also would consider, if you had an individual that had worked at one of those large successful funds for a number of years, if they were starting a new fund, that's a time when they might consider an emerging manager. But a lot of it came down to, who are the individuals investing? What is their track record? Obviously, what kind of terms are they providing? Are they market terms? Do they have co-invest opportunities? Sometimes we would do that as well. But a lot of it was based around that manager selection, and then taking into consideration, do we already have a high allocation to multifamily? Maybe we need to be allocating more to industrial, for example. So that type of thing.
I see. Fascinating. In terms of the kind of returns that they expect to get, like what kind of returns is market returns to them?
Yeah, that's a good question. They would typically target, like, they weren't looking for the most aggressive, risky strategies out there. They were fine with a more, say, mid-teens IRR. And especially at the time, interest rates were very low. So that also made more sense at that time too.
Mm-hmm.
But most of the time, mid-teens IRR. And then they were looking for more market terms, I would say, on the fund side, waterfall structures, let's say like an 8% preferred return, and then maybe an 80-20 split after that. But more aggressive waterfall structures were not appealing to the endowment.
I see. Okay. That's good to know. I was thinking that their expectation would even be less than the mid-teens there, but that's pretty interesting. All right, now let's talk about ATX. The whole story about how you guys in the last 5 years sold over $1 billion worth of assets. That's a great timing, amazing timing, right? You didn't hit the peak, but it was pretty near the peak. That's amazing insight. Can you give us more insights into that decision? Like, I know you mentioned the cap rate being compressed, and what are some of the other key factors that play a role in that had you guys see, okay, yeah, it's time for us to get out?
In line with where pricing was, we had noticed that a lot of other groups had entered the space that had a similar strategy. So just looking at the competition for winning these types of deals as well. But ultimately, I think it's much easier said than done, having a really disciplined approach and having a contrarian mindset and not being afraid to, when the rest of the market is continuing to invest. And it's particularly difficult if you've walked in a good track record like that, and you have a lot of happy investors who are basically saying, all right, where's the next deal? Where can I put my money? And then on the other side, you have brokers who have worked with you for years, who they're making a lot of money off of you. They're starting to provide you a lot of good off-market deals. So they're pushing deals as well. They're saying, hey, they're really trying to, you basically have two different groups that are using all their negotiation skills possible to influence your decision making, but having the discipline to take a step back and say, all right, now this is going to be a really tough decision. We're actually turning down money in our pocket today, but keeping in mind our fiduciary duty to our investors, what's going to make the most sense for them, and just being really focused on the customer. And then ultimately too on establishing that long-term track record, knowing that when the next buying opportunity comes along, the people that have that type of track record are going to be the ones that are going to be in the best position to buy up new properties at heavy discounts.
I saw your track record. I think the one that I saw had over 100 assets in it. And I think I saw most of them, of course, were profitable. I saw, I think, one that lost money and one that broke even. And that's out of, was it 115 or 130 different assets?
Yeah, we've done about 115 deals, and yeah, we did have one that lost money for our investors. Now that's still batting over 99%. So
exactly. I know.
That's very good.
That's why I brought it up, because that's just an absolutely amazing track record. And it's not like you have been around very long. 19 years is not, but you said 2005 or 2015? 2005, right?
2005 is when our founders started to invest, but our track record was established in 2010 through today.
2010. Okay, yeah, perfect timing too. 2010.
Yeah, absolutely.
Oh my gosh, you guys got amazing timing on your entrance. You got amazing timing on your exit. That's and yeah, from 2010 to today, 115 assets, only one lost money. I'm curious, we can definitely talk about all the good deals, but I'm just curious as to what happened in that deal that lost money that kind of threw off your track record there.
Yeah, so you're asking what happened with the one that we lost money on, basically, right?
Correct, huh? Yeah.
That was a deal that was, it was very, very labor intensive, Class C, heavy value add. So this was one that was going to be requiring extensive upkeep and management to execute on the business plan. It was this, we also acquired this one in 2018. So it was one of the later acquisitions that we did during our huge run of investments.
Right.
There was also a situation on site where we had some staffing issues because there was some crime at the property. And then right as we were working our way out of that, COVID hit in 2020. That exasperated the issues that led to cash flow problems. And then coming out of COVID, you guys may remember there were a lot of regulations about when you could evict people who weren't paying.
Yeah.
So we had a situation where a number of the tenants weren't paying. We couldn't actually evict them. So that exasperated the cash flow issues as well. We also had the debt maturation happened last year. And so we were forced to sell at that time. But one thing that's important to note on this deal is we have the opportunity to exit earlier at a significant profit for our investors. However, we had a JV partner in the deal who had buy-sell rights and declined the sell. And so fortunately, we couldn't sell when we wanted to. So there were a couple lessons that we learned from this. One is, if we're going to have a labor-intensive, higher risk acquisition, it needs to be closer to our headquarters and where we have a heavy density on our property management company's side, where we can keep close oversight of it. Also ensuring that there is a really healthy cash buffer there in modeling out those downside scenarios if there is a recession. But most importantly for this deal, because it would have been a successful disposition for us, was thoroughly vetting that JV partner and making sure that there was alignment in the way that we were looking at when to actually sell that property. And that's, I would say, the overall most important thing that we've learned from this. So going forward, we've been very careful about the partnerships that we've gone into. It can be tempting at the time to take that money and run, but keeping in mind that it's essentially a mini marriage and this is a long-term relationship. And if there's not alignment on the front end, then that will eventually impact your overall returns and your investors' returns.
I see. Okay. Yeah, that's so much to learn just in that. So do you guys still do Class Cs now? Is that
We will
still?
occasionally. I think people have different classifications for different vintages in renovation level, but we'll look across the board from 1980s through 2023 build today.
I see. Okay. And then, yeah, and I do remember you have one other deal that was a break-even deal, correct?
Yeah,
Okay.
exactly.
Yeah, yeah. That's just one loss, one break-even out of
Yeah.
115 is just absolutely incredible track record.
Yeah,
Have you guys?
yeah.
Yeah.
One thing I would add about that break even deal is
Mhm.
that was part of a portfolio sale. So
Okay.
the overall sale was successful, but the buyer basically had a requirement that they had to buy that property at that price. So it was more of a package deal. Otherwise, we would have done well on that
Ah,
disposition as well.
that's an interesting. Okay, that yeah, that's an interesting deal structure. So fascinating. Um, and now you guys are back in your. I know you have a deal that you're acquiring now in Dallas. You're looking at a deal in Jacksonville. So you guys are pretty heavily back in now. And what's the
Yeah,
outlook? Yeah, what are you seeing here in 2024?
absolutely. So last year, beginning early of last year, is when we really started to crank up our acquisitions activity, our underwriting activity. And over the course of last year, we looked at a ton of deals. We looked at a couple hundred deals, and we only did one acquisition because last year, as I think a lot of you guys are familiar with, there was still that bid-ask spread between current owners and potential buyers, where a lot of the current ownership groups were acting like it was still 2022 when it came to pricing. And so a lot of deals weren't getting done, or the ones that were getting done were other groups who were more aggressive and less disciplined than we are. This year, like you mentioned, we have two under contract that will be closing. We're closing at the end of this month, one towards the end of May. So we've started to see pricing come down. In the markets we're looking at, we've seen pricing come down about 20%. Both of the acquisitions that we're buying today are 1980s vintages, and we're acquiring them both around a 6.3 cap. If you're comparing that to cap rates over the past 2 years, it's a phenomenal cost basis. And they're all about 20% under sales comps as well. So pricing has definitely come down. We've seen, of course, less competition in the 1980s vintages. We are looking to have a well-diversified portfolio with 1990s and 2000s as well. But so far, we're still seeing pricing there is a little bit unattractive for us.
I see. Okay. But what's the reason why the 80s having less competition is because the institutional players are only playing in the 90s and 2000s, or is that the reason?
Yeah, a lot of other groups, a lot of other institutional players or big private equity firms will have a hard cutoff on 1990s vintages or 2000s vintages. Some of them will have a hard cutoff when it comes to ceiling height. So that's part of the rationale for the 1990s cutoff, where most of the properties in the 1980s have 8-foot ceilings. So they see higher demand with 9-foot ceilings and above.
Mhm.
But also part of it, I think, is a bit arbitrary in the sense that is there really a big difference between a 1988 and a 1991 deal? No, but so that can be an opportunity for groups like us is if you have a little bit more flexibility looking at right under the cutoff for a lot of these groups where they may not be taking a look and you have essentially the same deal, but the pricing can be very different.
I see. Okay. Let's talk about capital raising. For you guys to have done over $2 billion worth of deals, right? In total exit. I'm sure, yeah, you've raised hundreds of millions, over 300 millions. Share with us, what have you found to work well for you to raise? And also too, do you mostly raise from retail investors only, or do you also raise from family offices? Yeah.
Yeah, absolutely. So we raise from a wide range of investor types. We have over 300 high net worth investors with us. We have family office investors. So we have about 10 family offices that have invested with us in the past. And then we also have traditionally always had a fund offering. So for investors who want that diversified exposure, but don't want to have to necessarily diligence every deal or make a selection on the allocation and have trust that we're going to make that smart allocation for them, we provide that. So we try to appeal to a lot of different investor types and provide the offerings that they would want. On the high net worth side, that's probably been our biggest bucket. And a lot of that has been, we've worked with different placement agents, but a lot of that has been relationships that we've built up, or people affiliated with the firm have built up. And I would say a lot of it's just continuing to persistence on the sales side and continuing to crawl through networks. And especially when we have those happy investors, asking people for referrals. We've seen that works very well, and our previous investors have been very likely to offer referrals when we've done well for them. But a lot of times, people won't necessarily think to do that on their own. They need to be asked, right? And basically being fearless with the ask too. Like sometimes we'll have to hit people somewhere in the range of say 5 to 12 times before we get an answer from them. But our overall viewpoint is that, hey, we're providing them an opportunity that they otherwise would not be able to, and that it's a critical part of their portfolio, to having a well-rounded portfolio. So it's like a gift for them. That's the mentality that we go into this, is we're trying to help them. And so we're going to be persistent, but we're not going to be desperate. It's a take it or leave it, but we're going to keep talking to you until we get an answer, because we really believe in the product that we're selling. On the family office side, that can be a bit harder to find those networks, but a lot of that was trying to identify the gatekeepers who have access to that, and then being very persistent until we can get in front of them, and knowing that once we get in front of them, we have a great track record to sell them and a great story to sell them. So we're exactly the type of group that they should be investing in. And then on the JV and co-GP side, we've reached out directly to a lot of those, but a lot of those too, there's great placement agents out there who will form those introductions, and especially if you have that track record and you've done it before, they're more than willing to make the introductions. They get that fee up front, but after that tail period burns off, then that relationship is ours to continue to foster for years to come.
Okay. In terms of new retail investors coming into your funnel, what kind of marketing do you do to attract the new ones? Not the referrals, brand new people that you don't know, what are some of the marketing channels that you guys implement to attract them?
Yeah, so we do a lot of posting on LinkedIn, on social channels, and we've seen a lot of inbound requests from that. We also will, and then from those postings too, if we see that someone is following our page, is engaging with our content, we'll reach out to them and say, hey, are you interested in seeing our deals too? We've seen a lot of investors are interested in that. That's a great way to do that. And then we also have a ground game approach too, where we will do educational events or informative events here in Austin. We also will go on the road a little bit. We've done events in Tampa, which is where we have a heavy presence as well, where we'll do happy hours, or we'll bring in economists. So we brought in an economist named Jay Parsons, who some of you may follow, but he was the head economist at RealPage. We did an event with him at Hotel Ella, one of the hotels we own. We had about 100 people for that event, and then we were able to follow up with people. We provided them value, of course. They make introductions. We generated investors from that. And then we also try to make appearances on podcasts where it makes sense. Overall, I would say it's a combination of posting. It can be direct outreach. It can be in-person events. And then we also are always looking for other syndicate partners who have those networks that they've built up. They're looking to basically lean on our track record and gain some expertise from us where we can help them out. That's also been a great channel for us.
I see. Okay. Now, at your level and your track record, are you guys at the level that you can start attracting attracting endowments yet? Or like what level do you have to be to attract the endowments?
Yeah, I think we're getting close. I think endowments still have, when it comes to smaller endowments, that's definitely a space that we can start to work our way in. That's a space that we haven't pursued too aggressively yet, just because we have our primary retail investor channel, our family office channel, and our other private equity JV and co-GP channel. But we are, I think, at that level where we can compare our track record to the people that they're looking at, and we're right up in line with the first quartile. So that's something that they're definitely attracted to. But that can be a much longer sale process. And there's also there's an attitude in that space where they like to see that that another endowment has already invested with you. So you can start to see a scenario where, say, all right, who else that we know, who of our peers is invested with you? It's a very kind of risk adverse and non-adventuresome mindset that a lot of those groups will have. And not being critical, it's just the way it is. So they'll look for who of our peers is invested. So the key thing is working our way into that first domino, and then the sale to others down the road could be much more quick.
I see. I'm curious, when you say small endowments, like what their check size are typically for a small endowment?
On some of the smaller ones, you could have a few million. It could be 5 million or 2.5 to 10 million overall allocation. Yeah. And a lot of that obviously comes down to, on their side, how much of their overall allocation is dedicated to that strategy. And then they know their funnel process to get to that allocation. Say they have to review 1,000 managers, they're going to choose 2% of that. For that 2%, then they can backward design into, all right, then I need to write a check size of X amount to the 2% that I find. So that's a little bit of a longer explanation, but for the smaller ones, depending on the size, it can be as low as, say, 5 million.
Okay. How big is your investor relations team?
We have a lot of us. We're a pretty lean team. We'll wear a lot of hats. While I work on the investor relations side, I also work on the acquisition side and the portfolio management side. Our total team is about 10 people. We have 3 others that are on the investor relations side, and those are mostly dedicated to our high net worth outreach and cultivation.
I see. So 10 is total for the whole company? Is that correct?
Yeah. Yep.
Oh, wow. You guys are very lean and mean. Okay.
Yeah.
So I take it you're not fully integrated, vertically integrated, like you outsource everything. Is that correct?
Yeah. Yeah. And so when I say 10, that's not including our property management arm. Our property management, we have a property management company that it has the same ownership as our firm.
Okay.
But that property management firm manages for our properties and for other owners and operators. And that's about 90% of what they do, is manage for other owners and operators. And they have about 12,000 units under management and about 400 employees.
I see. Okay. Yeah, that's such a different beast, right? You have on one company 400 plus employees, the company 10, a team of 10.
Absolutely.
Yeah, like the drastic difference in that. That's incredible. How are you guys able to run such a lean team just internally on the acquisition side and the capital raising side? Yeah, the core business, I guess, the core operation.
Yeah, so part of it is we do lean on that property management team. So they have business development folks that, of course, are concentrated on getting more units under management on their side. But as a result, they are boots on the ground in all the major markets in Texas and Florida. So they have good relationships with the ownership groups there and the brokers there. So that's one of the filters that we use for the deals, where they are on our deal pipeline calls and providing us intel on what they are seeing in the market and giving us an initial assessment of a lot of the deals that we're looking at. So that's extremely helpful. And so if you're counting part of their work hours, then the team starts to increase in size a little bit. But we're able to have a careful filter then on using their lens and our previous expertise on what we actually spend time on. And then a quick underwriting side, we can look at a deal, say in 30 minutes. That gives us a good initial assessment to decide whether or not we're going to move forward with it. And with having that intel of knowing what that submarket is like, what the ownership group is like, having intel from the brokers on how many bids they're expecting, that can give us a good gauge on whether or not to continue to pursue the deal. But I would say overall, it's having a careful buy box, having that intel, and then just being careful about where we're spending our time. And yeah, that's what it comes down to. And then on the investor relations side, a lot of it is making sure that we have a couple of younger guys who are the ones who are handling a lot of the outbound communication. And so by the time one of us is on a call, we're not spending a ton of time on the front end on basically farming those new investors. A lot of that is we're being handed those leads. So we've built up a strategy internally for them to be lead generating machines, right? And then we're keeping a regular contact with our investors so that we can get those quick referrals, or if there's any happy investors, make sure that they know the deals that we're working on so we can roll their capital into those deals.
I see. Very cool. Has all your deals been syndications? Have you guys thought about starting a fund, or do you have a fund already?
Yeah, so we've had 3 previous funds. We have 1 rolling fund today. Our typical deal structure will be, we'll have about a 5 to 10% allocation from the fund. We'll have some from the general partners or the family and friends here. And then we'll normally bring in, say, a JV partner or a co-GP partner for, say, 50 to 70% of the equity. And then we'll offer direct allocation to our high net worth partners.
I see. Okay. That's really good. And then so here in 2024, what are y'all's goals in terms of number of properties or is there an AUM you're going after here in 2024, 25, number of units? Like, give us some insights into that.
Yeah, so we're targeting, we would like to get at least 100 million in acquisitions this year, that's our low end goal. Higher end goal would be 200 million in acquisitions. We're targeting at least 5 acquisitions on the low end and 10 on the higher end. And obviously that's contingent on pricing continuing to be attractive and those deals being available for us.
Yeah. Given your track record, that seems like that would be an easy thing. Are you finding a lot of deals that are like distressed assets of some kind that you're buying?
I wouldn't classify what we're seeing so far as true distress. We're seeing motivated sellers in the sense that a lot of the properties that we've bid on today, you have a general partner who has a JV relationship, and that JV has a 5-year hold period where they have to recycle their cash. And so they're forcing the sale at an opportune time for them. So we've seen that quite a bit. We have seen some of the bigger, very aggressive syndicated groups over the last 5 years are definitely in distress right now. And we've seen from some of those, they're going through this period where they're calling capital, they're trying to recapitalize some of their deals. But our viewpoint there is that that's probably your last bullet, right? You can only call capital a couple of times from investors before they're going to say no. And at that point, you're going to be a forced seller. So I think we're starting to see early signs of distress from really aggressive syndicators over the last 5 years. And right now, we're just seeing more of those motivated sellers. And I think there's $1 trillion in multifamily loans that are going to be maturing by 2028. And in the interim, most of those ownership groups have floating rate debt. So if they have a rate cap that's expiring, say on an annual basis, we're going to see a lot of forced sellers that are going to be underwater on their loans over the next 5 years. But I think we're still, if this is a baseball game, we're probably in the 3rd inning, right?
Yeah, thank you, Michael, so much for being on the show with us today. Really appreciate your insights, your experience, and your company's track record is just absolutely amazing to me. So really appreciate you being on the show today.